Hey, Katie.
Hey, Cam.
You know, we don't do cold opens often. What in the world are we doing here?
Everyone's expecting my hello. So this episode is continuing the series that we've done previously about the stock market. And we realized that there's a lot of definitions in there. We should have thrown in some jargon violations.
We have a lot of jargon coming up.
A lot. And so this intro is kind of a little bit of a glossary almost. Mm-hmm. You remember when you'd have those books and it's like, here's some keywords to really understand, to identify and really grasp what you're about to read.
I think that'll be helpful for listeners.
So we're going to kind of go through this. Stick with us. It's kind of heavy definitions, but we're going to explain some of what's going to happen in this. Okay, so, market cycles, there are a couple of different forms, but the main ones are really looking at technical analysis versus fundamental analysis. So a technical analysis is really what we're going to get into with this, and it's evaluating statistical trends in trading activity, typically price movement and volume. So what is this doing? It's identifying trading and investment opportunities. Mm-hmm. Okay, makes sense, right? Yep. So fundamental, here we go. Assessing intrinsic value. What?
Intrinsic?
Hold on. Okay, let me read the definition of fundamental investors for you, and then we'll go back and explain it. Intrinsic value. So assessing intrinsic value of a security. Okay, remember a security, stock.
Yep.
Just think that in your mind.
Got it.
So it's taking the stock, a sector, or the overall economy, examining companies' financial statements, their economic indicators, and a company's news to determine, is it overvalued or is it undervalued? Mm-hmm. So really kind of examining, what should it be worth? The focus on this is earning and growth potential. So, okay, back to that intrinsic value.
I like that rewind sound.
It is value as calculated with regards to an inherent object measured. What?
All the big words.
It's really what it is saying, should this asset really be priced what it is compared to similar? Cam, I'm looking over at your Monster Energy drink. Mm-hmm. So if we were looking at that, should this Monster Energy drink really be charged as much as it is compared to a Ghost or different kind of brands out there?
Yeah, that makes sense.
So that's really what it's a fancy way of saying we're comparing the asset. Okay, so fundamental analysis is a study of the stocks as companies, earnings, growth management, market sectors, and geopolitical events like we've talked about. Warren Buffett is a fundamental analyst genius. And then technical analyst is the study of stocks like we just talked about. Again, I'm just kind of trying to give y'all a better understanding with this. So as we go into this, there's also going to be some other keywords where we're going to talk about the support or the resistance with the market. And you're like, is this rise or resistance? What's happening here? The stock market is very fascinating. There's lots of calculations. There's lots that goes into it. So nobody can just say, oh, my, crystal ball told me this stock was going to move. But the support level is as it sounds. It is the level that demands, is it strong enough to stop stocks from falling further? That's your support system. Hey, we're going to make sure you don't fall any further. Now, resistance, that is going to really be looking at the upward price trajectory, the impeding and overwhelming ability for it to continue to sell.
Yeah.
So it's going to be the opposite. Think about it that way. Okay, bull and bear.
Yep, we've all heard about that.
Bull up, bear down. Mm-hmm. Okay, so that bull market generally rising, optimistic of the investor, strong economy. You're happy. Everyone's, looking upward. They're feeling good.
Bull is good. That's what I'm hearing.
Bull is good. So the average bull market, this is just the average, is 1,000 days.
Okay.
Which, a lot of people are like, well, that's kind of less than I thought it would be. We have secular bull markets, which are prolonged periods of upward movement that can last for years or decades.
Whoa.
But
decades.
But just looking at a basic average bull market, 1,000 days. Okay, we got to look at the opposite side of it. Bear. So that is when prices are falling. Bear market is when everyone's going, ooh, we got to bear down. We got to really plant our feet into the ground and stick to our plan. Calm down. Do not panic. We've talked about that here at Pickler Wealth Advisors. We've put out how to survive a bear attack / bear market. The average bear market is 289 days.
That is way less than a bull market.
Yeah. It's kind of like everything. People talk about the bad all the time. They don't talk about the good. So it's like, oh my gosh, we're in a bear market. We've been in the bear market for 200 days. We were in the bull market for 4,000 days. You've got to compare and contrast with that. couple other terms that are going to come up are going to be, looking at corrections. That's really been in the media a lot recently, is a market correction. And it's like, okay, well, as a girl, you hear color correction. So what does that mean? Like, you screwed up your hair. She's going to fix it.
Right.
And with anything, it's a correction. You're correcting your mistake. With this episode right here, we're adding a little bit at the beginning to make sure you understand what you're about to hear. So in a way, we're kind of correcting that. But with the market correction, this can be triggered by various factors. Again, it is not one size fits all. It could be geopolitical. It could be economic. It could be anything that really triggers this. But a market is going to decline more than 10%, but less than 20%. That's a correction. Bear is a decline of 20% or greater. So again, everyone goes, okay, is this a correction or is this we're turning to a bear market? And that's really looking at your percentages. And again, it's perspective because you can't compare how many points it went down 10 years ago because we're playing on a different playing field now. So really focus on those percentages. A couple other things, mark up, mark down. This, again, think about it in your day-to-day world with going to the store. Okay, it's marked up. You remember the episode of Big Bang Theory, her penny blossoms.
Yes, I remember that.
It cost her $2 to make it, and Sheldon was trying to get her to understand she needs to mark it up because if she just charges $2, she's actually losing money.
Yeah, there's no profit.
No profit at all. So a markup is the difference between the market price of the stock held by the broker-dealer and the price paid by the customer.
Okay.
So it's the profit.
Yeah.
It's really in that. Markdown is the opposite. Price reduction or discount. It's the difference between the highest current bid price in the market and the lowest price charged for the customer.
That makes sense.
So, those are really kind of just in a nutshell, real quick, some of the different definitions we've got. This episode is going to get real into the different indexes and the market cycles. So hopefully this helps and enjoy the show.
I think we've given our listeners a good foundation. I like this glossary idea. That's kind of cool. You ready to get to the show?
Let's do it.
Cue the music.
Hello and welcome to Bullcast Podcast. I'm Katie Pickler and with me is Court Winsett.
Hello.
And Cameron Spann.
Hey guys, how are y'all?
Okay, y'all ready? We are at the Bull Series Part 3.
The grand finale.
Yes, this is the last part of this little series we've put together. So we've learned about the stock market history. We've learned about indexes.
Yes.
And now we're going to talk about stock market cycles and how they work. Are you excited?
Oh, man, listen, I could talk about this stuff all day.
I don't know if we can beat the tree. The tree was the most exciting part.
That's, and talking about air conditioning, being, the first building to have air conditioning, being the stock market. A lot of times, if you ever listen to historical stuff, David talks about air conditioning happening in Congress and how then, before they were forced to really make decisions real quick before that heat got to DC. And then with air conditioning, it's like, oh, we can stretch it out as long as possible.
Yeah. You got to just laugh at the potential jokes of people sweating about their stock buys when there was no air conditioning. So clearly that room probably was rank and
a little funky.
Adding a little air conditioning probably helped the environment quite a bit.
Absolutely. Morale for sure. Okay, so we are going to play a little game.
We've been on a roll with games.
We like these little games. This is Bull Boom or Bull Bust game. I'm going to read out historical events, products, or trends, and then Court and Cam are going to try and guess, is it a boom, meaning it took off and made people rich, or was it a bust, crashed and burned?
Don't bust our bulls, Katie.
Let's go with this list. First one, Bitcoin in 2011. Boom or bust?
Are we taking turns or do you want to kind of collectively answer?
Y'all could kind of talk it out.
2011. Yeah, that seems like that was probably a boom.
Boom. It was dirt cheap. It became huge.
Yeah. To be very clear, we are not advocating for the purchase of Bitcoin.
See, all the disclosure.
Our disclaimer.
Yeah.
Next one, Beanie Babies as an investment. Now,
100% bust.
Yes. They made a show about it.
just recently watched it, and it was fascinating.
Yeah.
Zach Galifianakis, he didn't look like himself
Right.
at all.
He did well in it.
It was really, really good. Of course, then, like, I vividly remember, like, when McDonald's created the Little Beanie Babies. I didn't remember going to mom and pop toy stores, but Cracker Barrel.
Yep.
Cracker Barrels would you go to find the Beanie Babies. But it's just kind of broke my heart when I realized, like, what a jerk he was. Like, I didn't want to be supporting, but it is really funny because I watched that show and I had someone had given me a little giraffe Beanie Baby and I was putting it in, getting it ready in the nursery and cut the tag off of it. Because, babies don't need to have tags in there.
Yeah.
But I kind of, part of me was like, oh, you can't cut the tag off because it ruins the value. And then I watched that show and I'm like, oh, and the poem and so much that goes with
I
it.
literally had Thai Beanie Babies with the tags on them and the little
protectors.
plastic tag protector
Yes.
over them.
Oh, yeah.
I did too. It still hurt my soul. Abby had a whole Rubbermaid we pulled out when Stella was like 2. Her parents gave it back to her. They were pristine, and Stella just wrecked the tags. And it still kind of hurt, even though I'm like, these are worthless.
Yeah.
It's like, ooh.
That was a bust. Prices crashed in the early 2000s. I'd check out that show if you haven't seen it yet. It's pretty good.
Okay, next.
The dot-com bubble of the 90s.
We know the outcome.
I feel like it's called a bubble. That right there should give something away.
We know the bubble bust.
The dot-com boom of the early 90s boomed. People made a lot of money, but then eventually it did bust.
That bubble
in the early
popped.
2000s. A lot of people lost a lot of money when that bust happened.
Okay, what about Apple stock in early 2000s?
Ah, boom.
It's a boom because that's when the iPod, that's when Steve Jobs came back to reclaim his company. They launched the iPod, and then 06, the iPhone came out. It was booming.
Boom.
Yep, Boom became one of the most valuable companies. MySpace is an investment.
I gotta say that was a bust.
Yes, it was a bust. Facebook took over. GameStop. This happened in 2021, so this is still pretty fresh.
But the people that got hit were the people who were hedging. The Robin Hooders got, I don't remember what the people called themselves, but a bunch of people found out that there were a bunch of people that were hedging.
Can you very high level explain what hedging is?
Basically, there were a lot of people that were betting that GameStop stock was going to go down.
Okay, thank you. I just want to make sure everybody remembers that.
The Robin Hood gang found out on Reddit that they were trying to do this, and we're like, no, if we start buying stock in bulk, then the price will go up.
It's gonna give it to the man.
Yeah, and the price skyrocketed.
Yep. And there's a movie about this as well, Dumb Money. But so this one they've classified as a boom and then a bust.
Right.
Yeah, which that happens. I mean, it's kind of the same thing you could say about Beanie Babies. It was a big boom and then bust. Okay, fidget spinner companies.
2013 to 2018, that was the tchotchke every company handed out. And it's not giving us a time frame here.
Yeah.
Oh, man. I'm going to say, I don't know.
It's
so niche. Fidget spinner companies. I'm going to say bust, but I don't know.
It's bust, quick trend that then disappeared.
Yeah.
Okay.
And then Tesla stock in 2010.
In 2010, now see, this one is specific.
Yes.
And in 2010, I gotta say that, like, in 2010, if that was when the IPO was, I don't know when Tesla's IPO was, but if that was when the IPO was, I'm betting some people made some money on that. We know one guy who struck it rich.
In 2010, I had never heard of Tesla, but that doesn't mean it would.
IPO for Tesla was June 29th, 2010.
Okay. That IPO, I'm betting some people.
You want to boom it?
Yeah,
Boom.
If you invested $10,000 with Elon Musk 10 years ago, your stake would be worth $2.1 million now. A boom became a huge giant in the EV market.
I think Court and I got a 100.
Yeah, I think y'all did. Y'all did good.
A+.
Good job. Okay.
I'm very excited.
We talked about kind of different examples because a lot of people, all generations can kind of relate to several of these on here. They can kind of think about that, where they were when some of these things happen. And there's tons and tons more of examples out there. So what are stock market cycles? Stocks and the market can fluctuate on any given day. That sounds like something I said.
That is a crazy comment. What are you doing? Just coming out with these comments that are just crazy, Katie?
Can go up, can go down, or can stay the same.
Exactly.
Fluctuate or roller coaster. I mean, there's so many terms.
Velocicoaster.
There you go. U.S. stock market has historically gone through larger market cycles in which the market expands and shrinks over the course of weeks or even years. So let's talk about the 4 phases of a stock market cycle.
Okay. Terminology.
Terminology.
Whee! These are going to be fun.
Yeah, well, we'll just round robin this. So the first one, accumulation phase. What are you going to do? Like, you're going to hoard it all together. When a market is at a low, buyers begin to snap up stocks at a discounted price. So, I mean, you really kind of picture the squirrel hoarding all his acorns for the winter, like, getting it all together. You're accumulating, you're gathering as much as you possibly can.
Yeah, what was that? What was that movie where the squirrel? I know the squirrel wasn't on crack, but he was on like a lot of caffeine. Like he drank a Zoom drink and then collected all the acorns. Y'all didn't see? It was like backyard. It was backyard. So anyway, it was funny. The squirrel was funny. He amused me.
How long ago was this movie?
I don't know. I'll look it up.
Okay, so we've accumulated phase. What's our next phase?
Okay, so the next phase is markup phase. This is where basically prices have started to go up, but they haven't really started to rise. But people are noticing that people are buying, and so they start piling in on the market. And the pile in causes prices to start increasing. The stock prices, the market starts rising. It goes up as more people buy in. That is, again, called the markup phase.
Okay.
The movie is called Hoodwinked.
Hoodwink. That's right. It was like Little Red Riding Hood. Yeah.
Good times.
Okay.
All right, so we've had accumulation phase, markup phase, and now it's time for the distribution phase.
Okay.
Prices hit their peak, maximum level, and then early investors start selling. Sentiment becomes mixed.
Okay. And then the last one, the decline or the mark down. Okay. So we've got our red marker out and we're marking that down. We're marking down those prices because stock prices drop as panic sets in. 4 simple phases: accumulation, markup, distribution, and then mark down or decline. So what are some of the famous market crashes and recoveries?
This is so depressing.
No, I mean, like we've hit these before.
Yeah.
Everybody that listens to us regularly probably has these memorized, by heart by now.
As we talked about before, you've got a fact sheet on stocks or mutual funds or something. Like, you've got to look at the historical data because no one is allowed to predict what the future could be because nobody has a crystal ball.
Katie and I have lived through 2 of these. Courts lived through 3 of these.
The first one on the list is, of course, ladies and gentlemen, say it with me, the Great Depression. That's right. 1929, market went bye-bye. It went kabloofy. The big daddy of them all.
And then 1987, I believe David was pretty new into the business at this point. So he got to start Black Monday.
Yeah. As I have mentioned, I think probably several times, I had a friend in school who wore a T-shirt that was a Merrill Lynch T-shirt that said, "I survived Black Monday." Guys, I was older. I mean, it's not like I had just been born. I'd been around for a minute when this happened, so I definitely remember it.
Next on the list would be the 2008 financial crisis. I remember working my job in college and it hit, and I remember my boss being very stressed, but I was young and dumb and didn't know what it meant.
We were in college, so we didn't really understand what was happening.
Yeah, I was a sophomore.
What's kind of interesting is 2020, COVID-19 crash and the rapid rebound. David, pretty much started his career, and then soon after Black Monday happened. I got into the business in 2019, and then 2020 COVID happened. So both of us, fairly new into our career, got to experience a market crash and recovery.
What I find very interesting about these crashes and recoveries that we're talking about is all of them had external factors that caused a massive crash in a pretty much a single day. That is not what we're talking about when we're talking about the cycle.
Yeah.
The cycles you don't just reach the peak and then everybody sells off in a day and the market crashes. The cycle is a little bit more of a steady flow than that. I guess we bring up these crashes and recoveries to make the point that obviously the market does recover even after a big crash, but those aren't what we're talking about when we're talking about the cycle.
Yeah.
There are ups and downs, but overall it's a little bit smoother ride than just a crash.
Yeah. And so I'm going to dive a little bit deeper into the different cycles before we get into the bull and bear market, just to kind of elaborate a little bit more. The accumulation, as we talked about, this is when, institutional investors. So Court, tell us what institutional investors are.
Institutional investors are basically businesses, like the investment banks, those people.
Okay, so institutional investors begin to accumulate shares. There are major players who need to acquire large positions, but can't do it all at once for fear of driving prices higher and raising their cost basis. Okay, so this is a strategy. They buy at regular intervals when the stocks hit their desired price level. This supports the stock and moves it up slightly. So again, it's very strategic. They don't want to do a huge skyrocket stock and buy all at once. So they're accumulating, but it's not going to be abruptly. Then they wait for the move to be digested and the price to come back to their target level before repeating the process again. So you can be in the accumulation area for a while. During this stage, few retail investors might participate because price action is unremarkable and doesn't necessarily attract attention. On the other hand, this is where long-term investors might be able to position themselves to scale in or out of positions to take advantage of price movement. Buying everything at once means investors might miss out on a better price the next day or the next week. But a bite-sized approach can sometimes be a better choice than buying everything at once. However, this approach can raise your transaction cost. So there's a lot to take into account with that. Okay, so do we want to talk about markup?
Markup. Yeah, sure. 100%. Do I want
You
to
want
talk
to talk
about
markup.
Just as the accumulation stage is characterized by support and resistance levels containing the price action of a stock, the markup stage is identified by the share price rallying above the resistance level. Did you cover, when you were talking about accumulation, did you cover what resistance is? It's an actual technical term. We can't just throw a term like that out there. And
it's not just a ride at
This is like rise of resistance, right?
Yeah, no, these are actual technical terms. As a lawyer, I would call it a term of art. That's not what we call it in the financial sector, but resistance is something that there's a specific definition for. But anyway, when the prices break beyond that resistance level, the quote-unquote breakout happens, and investors will see a spike in volume. The volume spike is caused by institutions, individuals who didn't buy during the accumulation stage and are now purchasing the stock. They see that these are the people that are like, they want to time the market, and they see this stock that looks like it's going up, but they catch it early and they're trying to buy it before it really skyrockets so they can make some money off of it. They start jumping in, like I said, then the price is going to react accordingly. So during the market stage, price action can go from neutral to trending. We got a lot of big words here. So basically, you will see people that are watching the market are seeing that a stock price is going up as more people buy it.
That's when you start hearing the rumors, the trending, the buzz, and you really got to decide, okay, Cam keeps gloating about this stock. Is it too high right now? Should I not be buying it because it's now inflated superficially?
Well, slingers.com.
If investors begin to see higher highs and lower lows after a price breakout, it can potentially be an indicator that the markup stage has begun.
Okay.
So this type of movement can attract attention, and as more and more buyers purchase the stock, the uptrend typically gets stronger, and eventually that's gonna top out. It's gonna form a parabola. If you remember from your high school geometry, it's sort of on a graph, it would be like a U-shaped curve. So it sort of starts down here and it goes up, and then it's gonna top, and then it's gonna go back down and curve out on the other end. So it's relatively uniform, or not uniform, but symmetrical on each side of the top part. Yeah. And there you go. The markup stage, when it reaches that peak, it's done. And then we move on.
Yeah. So the distribution stage, as we talked about, was the peak. And so that's kind of the top that was mentioned. And this is going to be signaling that a rotation is taking place as early buyers, those that have probably purchased during the accumulation stage, as well as later buyers, may begin to start exiting the stock. Again, this is just cycles of kind of explaining how a lot of trends work in the market. Again, we're not talking about, necessarily anything specific on individual stocks and what you should be doing. This stage often seeks the stock's highest volume because bullish sentiment. Let's pause for a second. Remember, bull up, bear down. So bullish sentiment is positive. We got some positive vibes out there. Good vibes.
How could I forget? Yes. Bull.
Positive. So bullish sentiments is extremely high. Initially, new buyers may want to absorb the selling, but not enough to keep driving the stocks higher. In this scenario, the stock can end up collapsing under its own weight. Okay, so you're kind of at that point where you're at the top, you're teetering, and it's like, do we keep staying on? Do we go ahead and take our wins and get out? What do we do? This is something that a lot of people have gone through, and it's looking at the stock itself. Do you hang on for what's going to come after the fact? Do you ride the roller coaster, or do you get off the ride? Of course, you're at the top, so it's a little scary. You're going to get a big, steep jump down. So stage 4. The decline, the markdown. It's the final stage. At this point, many investors want to avoid this. Buyers who got in during the distribution phase and are underwater on their positions start to sell. Being institutional players are long gone, there are very few new buyers to absorb the increased selling, which can attract even more selling. This cascading effect can send prices down very rapidly on a large volume. This phase usually ends with a critical support level is breached and volume spikes many times the daily average, at which point most net sellers are exhausted. The stock can return to accumulation once again.
So the first thing that you mentioned when you mentioned accumulation, Katie, was you talked about institutional investors. Again, these are the big buyers of stock. We're talking about people with deep pockets that are buying large amounts of the stock. They have to have enormous holdings of the stock for whatever reason. Insurance companies, pension plans, like I said, investment banks, those kind of people. They start off the accumulation phase. They're the ones that are quietly buying up the stock to try and get their position where they want it. They also might be the ones that are very quietly trying to sell at the very beginning of the markdown phase. So, they're kind of leading. It almost seems like the cycle is kind of driven by them, but that's not exactly true. It's just that they're usually the ones that have their finger on the pulse the most. They're recognizing when you've reached the peak of that and it's time to start selling off. It's not that they're driving it. They are very in tune with what's happening in the cycle and they can react accordingly.
Well, and so that distribution can also be caused by geopolitical events or certain economic indicators, war, pandemics, housing market crashes, things like that.
And that's kind of what I was saying earlier. There's a difference between just a normal cycle and a crash. But even the normal cycle is influenced by events. But I guess what I wanted to make clear to people was not that outside events don't influence the cycle, but that the specific crashes that we talked about, it's not like that is always how a cycle happens.
No.
You don't have like a major skyrocketing price that goes up and makes everybody rich and then a bunch of people bail and they get to keep their money, but then a bunch of other people that didn't bail, there's a crash and they lose everything. I mean, that's not how this happens.
No. And that's where it's, a lot of times accumulation we call when like it hits rock bottom or it's a downturn. You could see this cycle happening and it's not going to be a big public, Tesla's hit rock bottom. Like it could be happening all the time and you're just not necessarily seeing some of these things happening. I mean, there's a lot of sentiment that goes into this. It's a lot with looking at institutional investors, retail investors.
Not that they probably need to know, but since you made me define institutional investors, let's also, retail investors is more the standard investor, somebody who is looking to invest their money, an individual, a person like you, fair listener. It's your people who looking to invest and see hopefully their investments grow.
So how long does a market cycle last? With a better understanding of what happens during a market cycle, the next thing is to know how long do they last? Is it days, months, years, decades? Well, you know what? It depends.
It depends.
It varies very, very greatly.
Yeah.
The average peak-to-peak length of a market cycle between 1945 and 2020 was around 6.25 years, according to the National Bureau of Economic Research. Keep in mind that this is just a rough average, and it's impossible to predict how long any current or future market cycles will last.
Yes. And if everybody knew, if it was a set time and everybody knew what the set time was for the cycle, then you would just get in at the bottom and get out at the top every single time. And timing the market would be easy. But that's not how it works.
So the longest bull market in recorded history in recent years lasted from 2009, early 2020. If it weren't for the pandemic, who knows how much longer the bull market could have lasted. It's worth noting that in the last few decades, from the 1990s and onward, market cycles have historically appeared to average closer to 10 years. How important is it for investors to understand the market cycle? Well, again, we're trying to educate you on this. So education is key. The more you know, the better, right?
Yeah. Yeah. Well, I mean, I think the most important thing about educating people about the cycles is markets do, like you said, we can only guarantee one thing. The market's going to go up, it's going to go down, or it's going to stay the same. Markets rise and fall.
Helping you manage your emotions because
exactly.
Namely fear, greed, this is stuff that comes comes into play to drive these market cycles. Even with an understanding that there are highs and low points in the market cycle, it's still impossible to predict precisely when those peaks or troughs will occur, those ups and downs. Yet investors who lead with knee-jerk emotions, we've talked about those before, that just like, I gotta get in there, gotta do this, as opposed to logic and data, they may try to time the market and squeeze every ounce of profit that they can out of investments despite the risk. So rather than getting trapped into the market's movements, this is things you need to consider is, really looking at the data, consider, the emotional aspect of it. Remember, you're not a psychic. We do not have that, crystal ball on our desk. And, you can't control everything. That's the other thing. So having a plan and how to get through the bulls and bears.
Yes. One of the things that we should point out to you is obviously there are ways that you can mitigate your losses based on market cycles, things that you can do to protect against major losses from market cycles that include, obviously, one of the biggest things is diversification.
We've never talked about that before.
Yeah. Diversification, making sure that your investments aren't all in one pot. In other words, you're not just certainly not just investing in one stock. That would be a lot, but also not just investing in stock and diversifying your investments overall so that you have different kinds of security. Diversification can help blunt the impact of market cycle.
Risk management. This is definitely managing your risk. Are you at risk with international, with exchange rate? There's so many different things that you can really manage your risk level. And it's also, risk and diversification go hand in hand, and having the education to know what is your timetable with what you're doing, having that educational background, or having those partners to help you figure out what's going to be best for you.
And then, of course, as we preach probably, say every episode, long-term perspective. Talk a lot about the fact that this is a marathon, not a sprint. You are in this for the long haul. You are looking for not just making a quick grab for some money so that you can go out and buy that sports car. You are looking to build up your portfolio so that you have money to live on for the rest of your life.
Yep. Cam helped put together a great marketing piece a couple years ago called How to Survive a Bear Attack. It was really about a bear market. And it kind of had this similar thing of it's, stick to the plan, don't panic, don't try and reinvent the wheel.
And you can find that at picklerwealthadvisors.com/bear.
But that's truly what it is managing expectations and kind of trying to weed through panic, because naturally, we all have that knee-jerk reaction. We have that fear of missing out of, why didn't we get into this yet? Or why shouldn't we do this? And so again, that's having a wise relationship when things are not going crazy, understanding what your money needs to do for you, having a partnership of somebody who can help you navigate through those emotional waters, because this is emotional. As we've said on almost every episode, at the end of the day, money and finances goes down to the most emotional aspect. And if somebody is talking with you about your money, they are at your core. They are really, you've opened yourself up to them.
I was thinking, in an alternate universe, in the Pickler multiverse of movies, we would have the Bear Network, Bearcast,
indeed,
Bear TV, Bear Talk, and Barrett's instead of bullets. It just doesn't sound as good.
No.
I'm glad we live in this universe. The bull is good.
I wouldn't mind lots of bears, especially if they were polar bears.
Okay, well, so this is the last of our bull series. Again, Bullcast is still going to be around. We've got lots to talk about. We've got a lot going on right now that we can do a lot of episodes on. And so really kind of wrapping this up, the stock market has its ups and downs, but over time it has always moved upward. So whether you're investing now or just learning, understanding cycles helps you to stay ahead. And so that's where...
helps you to manage your emotions.
And that's why do not be offended if you work with a financial professional and they say, I don't feel like it's right for you to invest. They are looking out for you. They're trying to navigate what's going to be best fit for you. And so that's why a lot of times people will start you out very conservative or very slowly because they really want to see your emotions, see your risk tolerance. Mm-hmm. Trust the people you're working with if you want to. That's up to you. I'm like, don't tell it. That's sorry, compliance world. If you choose to work with somebody, choose to find a reputable person, go on broker check, figure all of that out, make sure they are reliable individuals. But this is going to wrap up our cycles, accumulation, markup, distribution, and markdown. So hopefully this whole series has kind of given you a little bit more about the stock market, the history, indexes, and the cycles. And so now when you are trying to decide if you want to invest or not, or you're having a conversation and somebody's saying, oh, the stock market's taking a beating right now, or the stock market's up, you've got a little bit of knowledge on maybe what's causing some of that movement.
Oh, ladies and gentlemen, there's the closing bell. You've made it to the end of yet another episode of the Bullcast Podcast. If you liked what you heard and you'd like to hear more, please feel free to go to your favorite subscription service and sign up to have our podcast delivered directly to your device every single Thursday at noon. If you'd like to find out more about Cameron, Katie, Cortland, or Nicole, please feel free to go to our website. That website is bullcastpodcast.com. We've got pictures up there, we've got bios, and we've got a place where you can drop a comment or suggest a topic you'd like to hear us talk more about. But hey, I mentioned pictures. If you like pictures, we do have an Instagram handle. That handle is at Bullcast Podcast. And we also have an X handle. That is at Bullcast Podcast as well. Finally, we have a Facebook page, which is Bullcast the. Don't forget the podcast. And we, Cameron, Katie, Nicole, and I all work at a place called Pickler Wealth Advisors. And if you'd like to find out more about us, our Bullcast page is not enough. If you'd like to find out even more about us, find out about what we could do for you, find out about our amazing team, and find out about our boss, David Pickler, please feel free to go to that website. That website is picklerwealthadvisors.com.
That's advisors with an O.
Not an E.
Ladies and gentlemen, this wraps our stocks. We have given you not everything you could possibly know about stocks in the stock market, but we feel like we've given you enough to be going on with. So for now, I'm Court.
I'm Katie.
I'm Cam.
And we're done.